So I came across this graph that indicates, based off of your overall dividend yield, how much money you need invested to earn certain amounts of dividends. I personally find this glanceable info very insightful, so we're going to take a look at it in this video. We also have to talk about the state of the current US economy. The markets finally seem to be convinced that the Fed can indeed pull off this mystical soft landing. I'm sure you guys remembered that all of 2022 we have been predicting and waiting for this upcoming recession to finally hit. We had tons of articles day after day with titles like this: the US economy and stocks face a difficult year and could even lag Europe. Analysts told CNBC they believe the US had reached the end of a post-global financial crisis rally. Kind of interesting considering this article was posted in the tail end of 2022, right before the market rallied like 30%. And if anything, based off the data, it seems like China is the country that's struggling the most with keeping up with growth expectations. So we have a lot of stuff to cover in this video. I hope you guys enjoy. And let's begin with this chart of how much money you need invested to earn certain amounts of dividend income. So I do like the approach here of showing different portfolio yield amounts and how much income that generates. We know right now the market has an average dividend yield of about 1.5%. So even 3% is well above average and is probably closest to what most people actually have right now in their portfolio. And in this scenario, to make $24,000 per year in dividend income, which is probably the floor of what you need to retire and live off of your dividend income, plus Social Security and some other income sources, you would need $800,000 minimum. But the way the math works out, if you can double your dividend yield from 3 to 6%, that cuts in half the figure you need invested to generate that same level of income, $24,000 per year. For most people, the mid $50,000 per year in dividend income is what they want in order to retire and be comfortable. And here with the 3% dividend yield, that requires almost $2 million. And with a 6% dividend yield, that figure is almost $1 million. So certainly a very fun and informative graph to look at when deciding your dividend strategy. Okay, so now let's shift and talk about the macro state of the US economy. It seems like the rally we've been experiencing year to date so far is indicative that the market is expecting the Fed can actually pull off this soft landing. Going back just a couple of months to last year, if you said that you believe the Fed can pull off a soft landing, you were essentially laughed out of the room. A big reason for this, one of the largest data points, is that the fight against inflation is going surprisingly well. So the latest reading of inflation was just 3%, only 1% above the 2% target of the Fed. So this continues the strong downward trend in comparison to last year when we peaked at a rate of, I think it was 9.1%. And the big fear that a lot of investors had was, even though inflation was coming down pretty strong, at around the 4% mark, inflation would become more sticky and entrenched, and the journey from 4% to 2% would be much more difficult than from 9% to 4%. But with the latest reading, we went straight from 4 all the way down to 3% in 1 month. Inflation expectations is also very important because it becomes a self-fulfilling prophecy. If people expect inflation to be high, they spend more today, raising inflation, and it's that positive feedback loop. But even this is positive. So based off of the data we have right now, people are expecting inflation to come down pretty soon. So that's one of the biggest factors contributing to this idea of a soft landing. The Fed seems to be winning the battle with inflation. And the other very important piece of data is that the US economy is still very strong regardless of this inflation fight happening in the background. Unemployment is still near a historical low point. People were concerned about company earnings. We're currently in the middle of the earnings season. But again, we're not seeing that. Another welcome piece of news is it seems like the job market is normalizing as well. So the number of job openings is beginning to revert back to the mean. And the term labor shortage is just being mentioned less and less by companies. So most of the data indicates that right now the US economy is doing really fantastic given the circumstances. And today I was watching some CNBC and they had a guest, Tom Lee, and he explained how he sees a new all-time high for the S&P 500 this year based off of some of this data.
Trading, you think we hit new highs this year?
Yes.
All-time highs in the S&P.
Yeah, I think we'll be well above the prior highs.
And even other developed markets like the European market and the Japanese market are doing much better than expected. It seems like the only country that's coming in below expectations right now is China. They recently missed on their Q2 growth rate by a full percentage point. Youth unemployment is over 21% right now, and I was watching this interview on Bloomberg television with Secretary Janet Yellen talking about the issues China is facing right now.
So I think China has seen slower growth than they expected upon opening up from COVID. Consumer spending has been relatively weak.
And she did indicate that she doesn't believe that this slowdown in China will negatively impact other markets like the United States. If anything, the slowdown in the Chinese demand might help with inflationary pressures on a global scale. So that's the latest macro news on the state of the economy. I hope you guys enjoyed, and I'll see you guys in the next one.